All right, good morning, everyone. So happy to be here in sunny Southern California. Rick, your home state. As always, changeable weather. Thank you so much for providing.
Yeah, tomorrow's supposed to rain, so you got in just in time.
We're joined by Chris Dorin, head of sales here at RCN Capital. Of course, Jeffrey Tesch, CEO. Really glad to be here, touching base on what's happening in the marketplace. So I really wanted to touch on investor sentiment this morning. Optimism seems to be picking up. We've seen it in our data, although it's changeable with our investor sentiment survey. What are you seeing in the broader marketplace, Rick?
Investor activity is interesting, Jeff. The amount of transactions happening right now is actually a little bit lower. The sentiment seems to be positive with an outlook toward the future. But we just came out off a fourth quarter, which was the third consecutive quarter where there were fewer flips than the quarter before. I think we were down in the 60,000 range in terms of the number of properties flipped. That's the lowest number in several years. And I think investors have probably weathered this particular storm to get to where they are today, and they're looking at market conditions improving as we go forward. And that was certainly evident in our spring investor sentiment survey.
As a follow-up, what have we seen across, let's say, the past few sentiment surveys on what investors are thinking about and how investors should start to be thinking about how this year unfolds?
You said it really well a few seconds ago when you said it's a changing situation. Sure. What we've seen over the last year of these surveys, and we actually have now completed a year of surveys, is sentiment has become less and less pessimistic. And the number of people with a positive outlook isn't necessarily off the charts, but we've at least moved a huge chunk of people from negative to neutral. And I think the reality is they are seeing these market conditions change and reacting to that. There are opportunities for investors. There's still a critical shortage of homes available for sale. So if you can find a property to flip, you'll be able to find somebody to buy it. Affordability levels are still very, very low across the country. So a lot of people who would have bought a property are now looking to rent. So there's lots of rental opportunities. And I think those opportunities are what keep investors fueled. But the reality is high financing costs, high property costs, and a variety of other things are providing headwinds and make it tough for investors in the market.
Hope is eternal, Rick.
Hope is eternal, and spring's eternal, and eventually we'll get spring weather.
Chris?
Rick, you mentioned the survey. There's a difference, though, in opinion between what we see from rental investors versus fix and flip investors, right? There's a different level of optimism there. Maybe you can touch on that a little bit and kind of work through, where we're going with those numbers.
It really is ironic, Chris, because we were just talking about the fact that we've had fewer and fewer flips over the last few quarters, and yet the outlook from flippers is significantly more positive going forward than what we're seeing from rental investors. And I think that's also part of current market reality. If you look at rental rates over the last 18 months, after hitting all-time highs in terms of percentage gains year over year, in most markets, rental rates are actually negative on a year-over-year basis right now. Now, it's a little better for single-family renters. Those single-family property rents are still up, but maybe only 2.5% from a year ago. So I think you're looking at a combination of higher purchase and acquisition costs, higher financing costs, and less ability to make up for those costs with rental rates. That's making those rental property investors a little bit more negative with their outlook.
Understandable. And I think you could also look at, like you just said, right, the timeline for people projecting into the future, right? There's different levels of optimism as we look forward versus what we're seeing now in the market.
There's another issue, and I'm glad you mentioned the timelines and things that change over time. We're at a market right now where there's about 1 million apartment units coming online. And while most people looking for a single family home to rent may not be your typical apartment renter, it's still competition. We're looking at share of market for rental properties. And in some markets, we're going to be oversaturated with rental units. So there are challenges for rental investors. I don't want to paint too rosy a picture. But the counter to that, as I was saying to Jeff, is that there are probably several million people who would have been buyers right now, but can't afford today's prices and financing costs, and they're going to be renters. So there are opportunities, and I think that there will be opportunities now for the next couple of years as those people rent rather than buy.
So I would to sort of dovetail off of that, I think a tremendous amount of investors, certainly in the RCN community, but the broader ecosystem that we participate in, want to understand the multifamily renter outlook versus the single family home renter outlook. And when investors are out there considering buying, whether it be small class C, B, A multis versus either single family homes or even portfolios of single family homes, it's often a difficult decision because of what the expectation for rents is going forward, and certainly demand.
Yeah.
What are you seeing?
Well, demand is a tailwind. We have the largest number of young adults between the ages of 29 and 34 that we've ever had in the history of the country. There's hundreds of thousands of people turning 35 every day. And so these are people that are in prime age for household formation, prime age for home ownership, at least that first home. But in many cases right now they're renting. So there is, demographically speaking, a tailwind that demand should be increasing. And we are seeing the percentage of young adults living at home starting to come down. And that's mostly because my son's finally getting married and moving out. But that will provide the demand you're looking for. Now, the challenge, of course, is you go market to market and have to figure out, are you one of the markets where there's so many apartments coming online that you're going to have a saturation effect? And again, although technically a single family home renter is a little different usually than an apartment renter, if you have all of those options available to you, you become a shopper. And where you might normally rent a home, in this case, you might rent a multi-bedroom apartment. So as an investor, you really have to be paying attention to those local market conditions. And there's a fundamental difference in pricing right now in terms of trends. So 2 years ago, coming out of COVID, we had asking rents on apartments that were up 15% year over year. Right now, if you look at the most current data from places like Real Trends, the asking rents are down almost 1% year over year. That's for apartments. If you look at data that's put out by other sources like CoreLogic, you see that asking rents on single family homes are up about 2.5%. And that's across all categories, whether it's the low end of those single family units all the way up to the more expensive ones. So they're all positive, but only 2.5%. And home prices, so your acquisition costs, are up about 5 to 6% year over year. So your acquisition cost is 2 to 3 times higher than that increase you're going to be able to get in rents, and you have to make that math work.
You know, thinking about different segments of the rental market, I think investors often take pause and think, well, I can get a good deal on a multi right now,
Right.
versus paying what some might argue is full price for a single family home rental. How does an investor think that through?
You have to look at both ends of that transaction, Jeff. I think it's a great point. There is going to be some distress in the multifamily market this year, particularly from syndicators who over-leveraged themselves and did that when interest rates were very low. And now those interest rates have reset, and their loans are coming due to reset, and they're not going to be able to pencil those numbers out at twice the financing costs that they took out the loans for. So you might be able to get some bargain properties in the multifamily market where you're probably not going to get as many in the single family market. On the other hand, are you buying distressed assets where you're not going to be able to get a market rent that pays your financing costs? So that's the double-edged sword that these investors are looking at right now. You might be able to get some better deals, but make sure you do your homework, make sure you get a calculator out and figure out that your rents are going to be able to cover the cost of financing, the cost of purchase.
Rick, you hit on it there, right? The number one challenge that investors continue to reference in the survey is the high cost of financing, right?
Yeah.
No surprise there, and this week hasn't done us any favors in the market either.
No.
But what were the other findings that you saw that did surprise you a little bit within the survey?
Oh, there are a couple things, and yeah, no surprise that high cost of financing is still the number one challenge. And to your point, what's going on with the inflation rate this week, and what that means for the Fed, what that means for mortgage rates, means those financing costs aren't going to be coming down for the foreseeable future. We added a category this time because we've seen home prices consistently go up over the last year, and rising home prices actually jumped to the number two most frequently cited challenge by investors. So now you have that kind of double barrel shotgun problem for an investor, which is your financing costs are higher and the cost of acquisition is also higher. That jumped ahead of things like low inventory, which is still cited quite often, and competition from both investors and consumers. And if there is a bright light in any of those things, it's that at least for this year, we're probably less likely to see a lot of consumer competition for these assets. I think we're going to continue to see consumers stay on the sidelines in large numbers until these mortgage rates come down. But that was a big surprise. And then we're seeing in real time the notion of insurance becoming a real challenge for the investor community, and it's twofold. It's the soaring costs of premiums, where premiums are doubling and tripling year over year. And in some cases, it's certainly happening here in California, it's the unavailability of insurance. You can't buy a property and get insurance on it in some parts of the market. Yeah. So that's really become a kind of focal point that we're seeing as a real major concern for investors right now.
I can understand that. And when you see those carriers pulling out, right, lack of competition now, you get more opportunity for those prices to continue to rise, and the problem just continues to have a negative outlook to it.
I think we were surprised at just how prevalent the situation was. When we ask a question of investors, how important is insurance as a consideration when you're going to buy or sell a property, and you're getting close to 70% saying it's a problem. When you're getting in the 50% range of investors saying it's caused them to miss a deal, that's a real situation. And that's something we hadn't even been talking about a year ago. It's an extreme problem in states like California and Florida. So if you look at some of these regional variances in Florida, 90% of the investors said that it's a major consideration when they're thinking about buying or selling a property, and 90% said it would cause them to miss a deal. And the numbers are very similar in California. I think 86% said it was a major concern, and 83% said it's caused them to miss a deal. And California and Florida, statistically speaking, are two of the states where you have most of the real estate investing going on. So it's a headwind that's a real challenge. And here's somewhere I disagree with our survey respondents. When they look out into the future, they looked at insurance as being probably less of a problem. I don't think it's going to get better. I think it's going to get worse over the next year or two.
Do you think that'll expand beyond the regional outlook that we've seen now and go more national?
Yeah, it's already starting to. It's most severe in Florida because of flooding. It's most severe in California because of wildfires. But Texas, I'm looking at you right now, probably next on the map. Texas has probably the highest percentage of severe hail events of any state in the country. And a severe hail event means hailstones that are more than an inch in diameter. Imagine those suckers coming down with 50-mile-an-hour winds and the damage they're doing to properties and cars and the like. So, that's probably one of the next states we'll see it. But with the number of extreme weather events we're getting across the country right now, whether you're a climate change believer or denier, whatever's causing it, this extreme weather is making it really problematic for the insurance carriers, and they have to pass those costs on somewhere.
When we look at the RC and Sentiment Survey, Rick, this particular quarter, was there any real surprises that jumped out at you that kind of gave you pause and thought, wow, I didn't see that coming?
The biggest surprise to me really was the severity of the insurance problems in Florida and California. And I guess I could have guessed that we'd see higher than average numbers in those states. But when 90% of the people who invest in Florida are saying it's a problem, that's unheard of. We haven't seen anything like that in the past where investors were almost unanimous in identifying a problem. and identifying something that's preventing them from being able to make their investments. So I just think the severity of the insurance problem was, to me, the biggest surprise. I was a little surprised that we saw the rising price of homes jump as high as it did in the rankings. We hadn't had that in there before, but the fact that it went from 0 to number 2 suggests that the price appreciation we've seen in housing over the last year, that we'll probably continue to see throughout this year, are really causing some stresses for investors.
You know, one of the things that's interesting about housing appreciation is how we look at the cost of financing,
Yeah.
and how that cost of financing will potentially mitigate the house appreciation, right? But then you layer on the lack of supply, and it's quite the pot of soup, right? I mean, you've got the lack of supply, not only for our investor community, but certainly for homeowners in general. But you've got the amount of debt that folks are needing to pile on to acquire that asset. And, you know, where do the two lines intersect?
Yeah, if I knew exactly where they intersected, I'd have written my book. We'd be doing this interview from my private island in the Caribbean. It's a good question. Last year, the supposition was that because interest rates were going up, home prices would come down. And we've never seen mortgage rates double in a calendar year before. So shock to the system wouldn't have been a surprise, except there were still more people looking to buy than there were properties available. So whatever properties did come to market, we were seeing bidding activity on, and that drove the prices up. The other thing I think forecasters miscalculated was the impact these interest rates were going to have on supply. And if you're a homeowner sitting on a $300,000 house where you have 20% equity and you have a 3.5% loan, you simply can't afford to go out and buy a $400,000 house with a 7% loan. You're going to be spending $14,000 to $20,000 more a year in mortgage payments than you were the year prior, and that's just keeping hundreds of thousands of properties off the market. So that's really, I think, what changed the math. If you were looking at what would normally happen if interest rates doubled to home prices, it kept more properties off the market than it kept buyers off the market. And that caused prices to go up. And I think we're in that situation now, at least through the end of 2024, simply because of what's going on in the overall economy and the fact that the Fed isn't likely to reduce the Fed funds rate until the third or fourth quarter of this year.
Best case.
Best case.
We're going to take a break here. We're going to add in Mr. Marc Heenan, Head of Growth and Strategy here at RCN. We'll see you back in a minute. All right, good to be back. We've added in Mr. Marc Heenan. Welcome.
Thank you, John.
Glad you're here.
Thank you. Glad to be here.
So, Rick, let's get back into thinking about how, and we've talked about how housing potentially inflationary, whether it be interest rates, lack of demand, but in the broader context of what we're seeing in inflation, there was a great deal of discussion about new construction and inflationary pressures there. Let's talk a little bit about the broader inflation outlook and how it's affecting both investors and homeowners.
Yeah, a lot depends on what the Federal Reserve does, because the Fed funds rate remains elevated. That's keeping mortgage rates elevated, which keeps overall financing costs elevated, which slows down everybody, consumers and investors alike. This past week's inflation report was a surprise to the upside. Wasn't a huge increase, but the market had been baking in a modest decrease in inflation. Or worst case, it was going to stay flat, and it ticked up a little bit, and that kind of has thrown everything out of whack. We've seen the stock market plummet, losing almost 1,000 points on the Dow Jones this week, and it's going to have a ripple effect for housing and for the real estate investing in general. The challenge I think the Fed is having right now with inflation is multifaceted, but the biggest problems right now are probably in services, where people continue to spend a lot of money on service-related items, and inflation there has been harder to get down than product inflation. And soaring energy costs. I don't know if you've driven around our beautiful area here in California, but The gas station I just passed, it was about $6 a gallon for a gallon of gas. Normally, we'd see the whole economy slow down with gas prices that high, and it's very unusual that we haven't. So, consumers are still spending a boatload of money. Prices don't seem to be slowing them down a lot. There's a concern that they're putting more and more money on more and more debt on their credit cards. We're probably up to $1.2, $1.3 trillion in credit card debt at a time when credit card interest rates are between 25 and 30%. And you'd have to think at some point this breaks and we see things start to slow down. But so far that hasn't been the case, and the Fed's not likely to reduce the Fed funds rate until they do see some economic slowing.
So let's touch on that for a minute. Number one is the amount of debt that consumers are adding to their personal balance sheets. But also, the other side of it is, I continue to hear this drumbeat of, yes, but there's so much money on the sidelines. Yeah. It's really it's a dichotomy there.
There, actually, if you look at the money on the sidelines thing, it's I guess it's a trichotomy, if that's a word. If not,
it is now.
Yeah, we're trademarking it. There's tons of institutional investor money on the sidelines. One of the things that we're not seeing in our investor survey is a steady drumbeat of, hey, I'm getting outbid by institutional investors. They're definitely keeping their powder dry in the real estate market, but there's a lot of private equity money, of institutional investment money that's on the sidelines looking for something to do. What doesn't get talked about a lot is we are talking about consumer debt, but there's $32 trillion in homeowner equity out there. And unlike what happened during the great financial crisis, we're not seeing people use their homes as ATMs. The number of home equity lines of credit that are being written has actually gone down now, both year over year and for several consecutive quarters. So for whatever reason, people aren't tapping into that equity to pay down their debt or to use it instead of racking up other debt, which at least begs the question of how much of this debt is renters versus homeowners, or is there some other reason that homeowners are reluctant to tap into the equity that they have? But it's a really unusual market in a lot of ways today.
Rick, how vulnerable is the banking community? Not so long ago, we had Silicon Valley Bank experience some serious liquidity crises. There are others that have followed suit. What kind of impact does the lack of liquidity in the banking affect our market, the rental market, the home buyer, et cetera?
It's a great question, Mark. I think the vulnerability of the banking sector has probably been overblown a little bit. Mm-hmm. We did have a shock to the system last year when we saw Silicon Valley Bank go down. We saw First Republic Bank go down. And then, you have echoes of those challenges when you see something like New York Community Bank. Mm-hmm. But in a lot of cases, when you start to parse what's going on, what you're seeing is really bad investment strategies and really bad management. And so I don't know how widespread that is across the country. I had a conversation with one of the senior economists from the Mortgage Bankers Association who follows the commercial market, and the concern with bank liquidity is largely tied into their exposure to commercial loans. Mm-hmm. And he had a really interesting point. He said most of the carnage in the commercial lending space is probably going to be in big cities, in the central business districts, with huge multi-million dollar properties that are now worth half of what they sold for the last time. He said your local community bank doesn't have that money. Tends to be an institutional investor who's holding that paper, whether it's from the insurance industry, retirement funds, some other hedge fund or private equity fund. That's where you're going to see a lot of the fallout. And you're going to probably see a lot of creative financing to get out of some of that fallout. The community banks tend to be more invested in local, smaller offices and retail centers and multifamily units. Where we could have an issue is if that fallout is worse than I expect or worse than the MBA expects in those local banks, the local and regional banks, it makes it that much harder to get more traditional financing for a multifamily property or for a low dollar commercial property. On the one hand, that opens up opportunities for the RCN Capitals of the world. But on the other hand, if you're getting a bridge loan from RCN and we're going to convert that into a more traditional longer-term loan with a local bank, that local bank may not be as much of an option. So it's worth watching, but I don't think the fallout's going to be quite as bad as what you see in the headlines.
Gotcha. And can we expect, with the carnage in the commercial real estate market, can we see a lot of the money that's been driving that market migrate more to single family? Is single family a safe haven for a lot of these people who are putting their money into commercial real estate projects? Will it migrate this direction?
In order for that to happen, Mark, you have to be looking at an institutional investor shifting gears from buying a 50-story office complex to buying a community of single-family homes. We are seeing a bit of a shift among the institutional investors in the single-family market, stepping away from competing with smaller investors, stepping away from competing with consumer home buyers, and instead shifting their funds into build-to-rent communities. It's still a fairly small percentage of the marketplace, but candidly, if I were an institutional investor, I would have been doing this years ago. You have much more price certainty over your costs. You have maintenance issues that go away because it's new build. You also know exactly what you're building and the quality of what you're building, so it's easier to predict maintenance costs. And you get out of the headline risk, or you should, because now you're not competing for available inventory, you're actually adding inventory to the marketplace. So I think we are seeing a bit of a shift in focus on the institutional side there. Will it be the same institutions who would have bought the mega mall or the office complex? I don't know, but it'll be that type of investor.
So Rick, I'd like to touch a little bit on geography and what we're seeing across the nation. With RCN's footprint, we're seeing investors coast to coast out there buying, investing, building. Let's touch on what markets are struggling a little bit right now and what markets continue to have a steady growth pattern.
It depends on how you want to define growth and struggling. Freddie Mac has been doing some really interesting work on population migration trends, and we continue to see a migration away from high-cost coastal areas into the south and southeast, and increasingly into the Midwest and even the Plain states. So we are seeing population migration in that case. If you look at California, where we are today, we're seeing a lot of migration away from the coast into the central part of the state, the Inland Empire, the Central Valley, where properties are more affordable, and then of course people migrating completely out of the state. I think I've told you the story, but my adult son getting married in September, teacher, his wife's a lawyer. They came to me to ask which state I'd recommend they look at so they can move there so they can afford to buy a house. Because the median price of a home in California is $800,000, and Dad ain't financing that for them. So I think that conversation is going on across the country. So what we're seeing is growth in states like the Carolinas, in Tennessee. We're seeing growth in places like Montana and Idaho. We are seeing growth in some of the Midwestern states. It's a little bit of a surprise. Not Illinois. Illinois is still losing population, but Wisconsin, Indiana, Ohio. Ohio has one of the best kept secrets in the country. We might have talked about this before, but Columbus, of all places, has been one of the best performing markets in the country for the last decade. And between the only university I'm familiar with that has a participle as part of its formal name, the Ohio State University, being located there, a very strong healthcare industry there, and now Intel's opening a fabrication plant there for chips. It's growing like gangbusters. So there are lots of pockets of opportunities like that. I think a lot of the Midwestern opportunity for investors is in the rental market. It's still one of the parts of the country where you can find some inventory. It's affordable, and you can buy it at a cost that allows you to have an affordable rent where you're still going to see good cash flow. So that's where I'm seeing a lot of these opportunities. It's tough to buy a rental property in coastal California. Florida, interestingly enough, is kind of a tale of two parts of the state. We see people migrating out of the south, moving away from Miami into the central and northern parts of the state, where we're seeing a ton of population growth and a ton of home sales. So it's really fascinating to see how this operates across the country. Texas, similarly, we see a lot of migration out of Austin, where prices have skyrocketed. but we're continuing to see growth in places like San Antonio and Houston and Dallas.
All right, well, how about sales forecasts? Here we sit. Our mortgage rates are at about a little over 7% right now. The 10-year Treasury is north of 4.5.
Mm-hmm.
Put on your crystal ball, your hat. Tell us what you think in terms of what we might expect for the rest of the year and into early next year.
We need to start dating these interviews and putting a big asterisk on whatever I say, because it all changes based on the time.
Doesn't it?
If we'd had this conversation literally a week ago, I would have suggested that we were going to see a rebound from last year's 25-year low number of existing home sales, that prices were going to moderate a little bit, and that mortgage rates would gradually decline for the rest of the year. And then inflation ticked up. Now it's virtually impossible to imagine the Federal Reserve lowering the Fed funds rate until September at the earliest, which means mortgage rates will not go down over the summer, which means we're going to have a kind of lackluster spring and summer home selling season again. And it may not improve much, because if the Fed funds rate doesn't go down until September, mortgage rates really won't start to go down until October. So I'm less optimistic that we're going to see that 10 to 15% bounce in the number of homes sold. We may wind up coming in just marginally ahead of where we were last year, so maybe 4 million existing homes being sold. And I think because of lack of inventory, you're going to continue to see prices go up maybe 3 to 5%. The one bright spot in home sales this year will probably be new home sales. The builders are on pace to bring about 1 million new homes to market this year. There's an appetite for these homes. Prices have come down from peak. Builders are still paying points to bring financing costs down. So I wouldn't be surprised if we saw 700,000, 750,000 new homes sold, which would be the highest we've seen in many, many years.
We have an election coming up. How does that play into the equation?
I ask the same question every 4 years. We have 337 million people in this country. These are the best two we could find, really. It's going to be a contentious election. It's going to probably result in all congressional activity freezing up for the second half of the year. We did see some proposals from the administration on housing in the State of the Union. They were well intended, but unfortunately all went exactly in the opposite direction. They were almost all inclined to increase demand, which is the last thing we need right now. So I think we'll see proposals coming out, but I think the market, I think the election will freeze up any meaningful reforms that might actually stimulate the housing market for the rest of the year.
Rick, thinking about how the lack of interest rate volatility, because we've really been in a trading range for quite some time now, has affected new construction. You certainly touched on it. The thought that we could end up with 750,000 new houses, I would think is good news.
It is good news.
Can the new construction industry, especially the large players, continue to deliver at those levels and really bring a meaningful change to the amount of inventory in the marketplace?
Yeah, I think that's the hope for the housing market, Jeff, is that the builders have shown no signs of slowing down. In fact, if you look at the number of permits issued over the first quarter of this year, they're going in exactly the right direction. We're seeing a lot of positivity from the builders in terms of future opportunities. So even though financing costs are higher than they were a couple of years ago, even though the cost of construction products, goods and materials, is up 65% in the last decade, they're finding a way to absorb those costs and still turn a profit on properties they're bringing to market. Partly that's because they're not building any starter homes anymore. So we are seeing a lot of inventory come to market, but it's all mid-tier, upper mid-tier, and high-end housing rather than entry level. And I think that's just the reality of the current situation. Fannie Mae did a study a few years ago that showed before groundbreaking, the average cost a builder absorbed across the country was $80,000. Here in California, it was $100,000. Hard to build an affordable house if your table stakes are $80,000 to $100,000, and we know that prices beyond that, labor, goods, and services have gone up. So It's fascinating to watch the builders succeed. I think they're doing it very judiciously. They're only building in places where they know there's demand. They're only building properties at price points that are affordable for their market, but also allow them to turn a profit. And I do think if we play this out over the next 12 to 24 months, you will see the builders continue to make a meaningful dent in that housing shortage we've been talking about for years.
You touched on this earlier, but the national builders often own mortgage companies, etc., and their ability to buy down rates for that end consumer is really making a big difference.
Huge competitive advantage. I was speaking to a group of lenders in Denver not too long ago, and there was a local builder taking out billboards advertising mortgage rates at 4.9%. And when you realize that, okay, existing home prices are up about 6% year over year, new home prices are down about 8% year over year. So that delta in the price, the median price of an existing home and a new home, is as narrow as I've seen it in years. You're talking about a new house for just a little bit more money, mortgage rates that are 2 or 3 points lower than what you get from a traditional lender. It's a huge advantage for the builders. And in some cases, they're not even working with their own lending operation. They're simply coming in and they've negotiated those points with other lenders. So it's across the board. But between those lower rates, the fact that they are building slightly less expensive, smaller homes than they were a couple of years ago, I think the new home market is poised to have another pretty good year.
Well, Mark, I'm going to give you the last question. We're running out of time here. Rick's got a panel to get to. What do you got?
Yeah, no, look, I just love to hear kind of if we could summarize everything that we've covered in this conversation. What are the biggest takeaways that our audience needs to hear from you?
There are still opportunities across the country, and there's opportunities in good times and bad times. Right now, we're in a really unusual time. We have people who would like to buy houses that can't buy houses. They become great opportunities for rental investors. We still have people that are ready to buy and qualified to buy but can't find inventory. There are opportunities for flippers. But you probably have to cast a broader net now, a wider net, and be looking at places that maybe are a little further afield than being right next door. And we know a lot of our investors, according to the survey, really focus on their local communities or certainly their home states. But a lot of the population, and a lot of the opportunities, a lot of the jobs are moving into the middle of the country, the south, the southeast, and those might be places where investors need to look for new opportunities.
Terrific.
Perfect. Thanks so much, Rick.